You are listening to chartingwealth.com for Thursday, the 18th of June, 2015. We always start with IYY here at chartingwealth.com. It is reflective of the total market, and the total market is sliding sideways. If you were watching us on our video, great, you can see it. If not, you're listening to us on audio. I will explain it to you. You can always see the video at chartingwealth.com. You can also follow us on Twitter, on Facebook and YouTube, and we have the video posted, and also at Google+. What you will see is the market has been sliding sideways since about the 9th of June, and it is about where it was. Well, it's still well within that large down candle, and it's about where it was back on the 11th when it moved up some, then it moved down some, and where the market ended on the 17th on the two-day candle is almost a doji, which means lots of indecision. Now, if we look at the short chart, because we are technically still in a down movement, crossed over going down on the MACD. Those of you not familiar with the MACD, MACD, it's the moving average convergence divergence. It is the only real indicator we use on our charts. We keep it simple. Just finished doing a teaching, a study that you're going to be able to hear in the next few days on Occam's razor, the law of parsimony, which says that if you have a method for doing things, always pick the simplest one of the workable ways to make a decision. And we have found that if we keep our charts super simple, whether you're a very experienced trader or just learning how to invest, it is so important to make accurate decisions and to make them as quickly as you can with as little overfitting, which means you have all sorts of statistical things that we're looking at that can confuse you and make the decision-making process either not happen at all because you're so confused you can't make a decision, or the statistical anomalies and the noise makes it inaccurate. That's why we keep it as simple as we can. So we had the MACD crossover going down between the 28th of May and the 1st of June, as we've been talking about since then. That's on the two-day chart. If we look back on the 4-hour chart, and again, this is for the whole market, just looking what's going on overall, we can see that we had a crossover going up around 4 p.m. or so on the 16th of June, and it is just below right now the newly redrawn trend line. What does that mean? It's hard to tell right now. The way that the market ended up at the end of the day was actually down. Now, for the day, it was up 0.2%. Now, that's not 2%, that's 0.2%, 0.2%. Not a big gain for the day. But as we look at the 4-hour chart, we can tell that there was a lot of up movement in the morning, and then the chart bled out over the afternoon. So we'll continue to watch. Derivative oscillators crossed over, as has the MACD, but this is on the 4-hour chart. So we are technically still in a down move on our two-day chart, on our total market. That's where we are. Don't be confused by what you hear on the news. Pay attention to the charts. That's how we keep from getting confused. We keep Occam's razor from cutting us. The law of parsimony, we want it to help us, not hurt us. So let's now go and look at S&P 500, the Standard & Poor's 500, as depicted in the SPY chart. What do we see? We see that again, we crossed over going down about the same time that the biggest chart did, the IYY. We crossed over going down between the 28th and the 1st. So the S&P is in a down move, still below the two-day trend line. We do have a green up candle for the past 2 days. It is almost a doji. Doji means indecision. It's like a cross. The bears pulled the market down as far as the bulls pushed it up, which means lots of indecision. So when we say that, we're still in a down move officially on the two-day chart. The big chart rules. When we back out to the 4-hour, the half-day chart, we see something very similar to what went on in the big market, the total market. And again, don't forget, the S&P 500 is 500 big companies. It's a a big part of the volume in the market, but it's not everything. So when we look at it, we see that it ended the day also bleeding out some in the afternoon, much more movement in the morning, and then movement down in the afternoon. It crossed over, the 4-hour chart did, on the S&P 500, going up between noon and 4 p.m. on the 16th of June. We do see the derivative oscillator flipped over today, but that was a significant 3 actual candles after the MACD crossed over. If you see them both transferring over at the same time, that makes you feel more strongly about the move. We don't see that, and again, it's the shorter chart. So where are we? S&P 500 still in a down move officially, thanks to the 2-day chart. Is it tightening up? Could it be getting ready to move over? It could. So what do? Well, we don't have any confirmation of that happening yet. Now let's look at the Qs. It technically was up for the day. The Qs were up for the day technically 0.28%, so almost 0.3%. The Qs is still, it actually, the derivative oscillator got bigger on the down move today. It was, again, a very small green candle for the 2-day chart, and it is just at the 2-day trend line, just crossing through that. If we drop back and look at the 4-hour chart, we will see that yes, indeed, it did cross through it in the afternoon and crossed over around 12 p.m., going up on the 2-day chart, on the 4-hour chart. And in fact, right after the crossing over around noon in the afternoon, the derivative oscillator crossed over going up. So pay close attention to the Qs. We don't have total confirmation yet, but you do have a number of clues, a number of things happening. Crossing through the 2-day trend line on the 4-hour chart, and you have the derivative oscillator and the MACD crossing over close to the same time. Not exactly the same, but gives you some more clues. So we are still, though, officially in down moves on all 3 of these indexes. Total market, IYY, SPY, the S&P 500, and the Qs, which is the NASDAQ 100. Now, lastly, let's look at gold on the 2-day chart. Gold is showing us a doji. We saw a doji back when gold got ready to move over going down on the 20th of May. Gold then crossed over on the MACD between the 26th and the 28th and has continued to move down until on the 9th. It started some up movements, not crossed over yet on the 2-day chart. However, we are seeing a coming together, a converging of the MACD. Looks like it could be getting close to crossing, and it may be crossing at the same time the derivative oscillator flips. However, today you have a lot of indecision. You have a doji, which means that the bulls were able to pull the market down as much as the bears were able to push it up. Nobody's in charge right now. However, there was a crossing on the 2-day trend line. You can't draw a trend line on the chart that doesn't have today's movement pushing through it. So that does speak to the possibility that gold is getting ready to make an up move. However, it has been sliding sideways for many days, and there has not been a great deal of movement in gold. If we switch over to the 4-hour chart to get a little bit better look, we can see that the 4-hour chart crossed over going up way back on the 9th, between the 9th and the 10th. It's continued to go up, and then it started losing steam on the MACD and the derivative oscillator up until this afternoon. It looked like it was actually going to cross going down. A little bit of boost up this afternoon, but it wasn't even anywhere near as high as gold had dropped on the 16th of June in the afternoon. So watch gold closely with all the indecision on the 2-day chart. Don't start betting that gold is going to go up. It's looking rather long in the tooth on the short chart for its up move. And the derivative oscillator has lost a lot of speed. So continue again. Remember the large chart rules. Pay attention. We so appreciate you joining us every day that you do for chartingwealth.com's daily review. Hope that this has been helpful as you go into the market on Thursday the 18th. We hope that you're making money. Hope that you're tuning into all of our training. We appreciate it. Again, join us at chartingwealth.com. Get our newsletter where you'll receive this video or audio every day via email, plus our trainings. We love to hear from you. Follow us on Facebook and Twitter. God bless. Wish you the best in trading and investing from chartingwealth.com.